Additionally, our 80 billion Sustainability Power-Up Fund provides financial support to local enterprises on their green transition plans. Outside of Hong Kong, Hang Seng Investment Management Limited collaborated with SAP Invest of Saudi Arabia to launch the SAP Invest Hang Seng ETF on the Saudi exchange. This provides investors in the Middle East with direct access to Hong Kong's capital market, which in turn enhances Hong Kong's status as an international financial center and a global super connector. Our continued business growth and strong capital position ensure we are well placed to maintain a steady and healthy dividend policy. I am pleased to announce that the directors have declared a fourth interim dividend of $3.20 per share, which brings the total distribution for 2024 to $6.80 per share, an improvement of 4.6% year on year. Before I hand over to our CFO to walk through details of our financial and annual results, I'd like to thank my colleagues and register this vote of thanks here for their dedication, agility, and creativity, which have enabled us to build our business and support our customers. And now over to you, Sei-Pin.
Thank you, Diana. The bank's 2024 financial performance reflects the positive outcome of the efforts made to diversify the revenue stream, mainly on non-interest income. As a result, non-interest income grew by 26% to 10,753 million, and the proportion of non-interest income to net operating income improved from 21% in 2023 to 26% in 2024. Net fee income increased by 8% to 5,316 million, aided by our continued strong performance in generating investment services income, mainly contributed by the growth in retail investment funds and security broking and related services. Net trading income, net income or loss from financial instruments designated at fair value through profit and loss, and changes in fair value of other financial instruments mandatorily measured at fair value through profit or loss, together recorded a gain of 1,044 million. This is in contrast to a loss of 148 million in 2023 and mainly reflects the higher revenue from derivatives product coupled with enhanced net interest income from the trading positions and higher foreign exchange revenue generated from increased client activities. Life insurance related income also increased by 17% to 3,119 million, with higher revenue generated from insurance services. On the other hand, net interest income decreased by 5% to 30,784 million, driven mainly by subdued loan demand on the back of the high interest rate environment and the declining rates in second half 2024. Compared to 31st December 2023, gross loan balances decreased by 5%, while customer deposits rose by 7%, primarily due to the growth in our customer base, mainly from new-to-bank affluent customers and mainland customers. Net interest margin dropped 10 basis points to 2.2% on the back of weaker loan demand, where surplus liquidity has mainly been deployed into high-quality financial assets. Our liquidity coverage ratio was 301% as at 31st December 2024. Net operating income before change in ECL and other credit impaired charges grew by 2% to 41,537 million. ECL and other credit impaired charges decreased by 24% to 4,773 million due to the reduction in ECL charges for wholesale stage 3 customers. As of 31st December 2024, gross impaired loans and advances as a percentage of gross loans and advances to customer was 6.12%, compared to 5.32% on 30th June 2024 and 2.83% as at 31st December 2023. Profit before tax increased by 5% year on year to 21,014 million. Attributed profit also rose by 3% to 18,379 million. Earnings per share grew by 4% to $9.33 per share. Return on average ordinary shareholders' equity remained stable at 11.3% for both years. Return on average total asset was 1.1%, up from 1% in 2023. As at 31st December 2024, our Common Equity Tier 1 capital ratio was 17.7%, Tier 1 capital ratio was 19.4%, and total capital ratio was 20.8%. In 2024, we continue to invest in our people and technology to deliver greater operational efficiencies and enhance customer experience. We also make good progress in diversifying our revenue sources and building a strong capital base, which has helped support a good dividend payout. Looking ahead, we will continue, as always, to manage our costs and risks in a robust manner so as to build a solid foundation that can deliver healthy and sustainable returns to our shareholders. Thank you all.
Thank you, Diana and Sei-Pin. We will now begin our Q&A session. Please raise your hand if you wish to ask a question, and we will pass you the microphone. Would you please also introduce yourself and your organization? First question from Sam. The gentleman on the left-hand side.
Sang Wong from Jefferies. Thank you, management, for your presentations. I have two questions, if I may. The first one is just want to check on the outlook for 2025 in terms of credit costs and NIM, and just also want to ascertain what is the exit NIM for December 2024. So that's the first one. And then secondly, a follow-up on the Hong Kong CRE situation. So we noted a further increase in the related NPL. Overdue loans also increased half on half. So just want to check where do you think we are with respect to the Hong Kong CRE cycle, so to speak, right? So are we still in the beginning of that kind of risk recognition process, or are we in the middle of the process, or you think asset quality migration pretty much stabilized from here? Thank you.
Thank you, Sam, for your questions. I think there are two main parts to that. I will cover the outlook first and pass on to Kathy to share with you a bit more details on our credit performance. First things first, I think what we have highlighted, or what I have highlighted earlier in terms of geopolitical and operating environment challenges will remain. We expect that will continue this year. Having said that, since the second half of last year, interest rates started going down. And that, in a way, actually eases the cash flow pressure on a number of, or some of our corporates. So that would be taken in quite positively. Now, at the same time, the rate of interest rates decline, I think, market is probably expecting this year there will be another 2 rounds. So with the changes in the interest rates environment, with the latest of the government policies we have seen, both in Hong Kong and in mainland, we are seeing signs of stabilizing in the market, especially in sales and purchase of real estate. Now, I think that actually is a major part of the economy, and we definitely hope to see that with stabilization then comes a bit more activities in the latter part of this year. I understand, clearly the views would be would that impact credit outlook, but I think it's still quite early days in February to actually set a benchmark or indication for the rest of the year, given the operating environment and the challenges are still real. I do think I would bring back to 2 points. One is that we have always been adopting a conservative as well as a prudent risk management approach. And I think that has done a lot of justice in terms of us continuing to de-risk our portfolio and enable us to better manage our risks. Our ECL has gone down 24% year on year in 2024. The 6.12% NPL you referred to, I'd also like to reiterate that it's a very strong book. 2/3 of that actually has strong collaterals. And the remaining 1/3 are really loans to large corporates with very diversified revenues streams, as well as 90% of those, over 90% of those are investment grades. So I think that says a lot about the healthy or the state of the health of the portfolio. And combined with our prudent risk management approach, we are confident that we will be able to weather the storm. Now, I'd like to bring back to the second point, and that is this, in the overall scheme of things, this really has not had material impact on our financial performance. Going forward, we will continue to adopt this approach, and with a view that we are able to continue to, we will be able to continue to grow our business and at the same time bring in incremental profits and revenues so that we continue with our dividend payout policy. And I think that commitment is there. And I wanted to stress that management has the ability to do so. Now, I'll pass on to Kathy for further elaboration on Hong Kong CRE. There are a few numbers I think you would want to take note of.
Okay, thank you, Diana. Hello, Sam. I just want to give out some figures for your reference. In terms of our NPL balance, loans overdue, which has overdue less than 3 months, is actually around 45%. And in terms of our Hong Kong CRE, 70% is still making some kind of payments, okay? And then in terms of our credit impaired portfolio, for Hong Kong CRE, our collateral, including ECL, the coverage ratio is over 100%. Also, for China CRE is 95%, and the overall stage 3 ECL plus collateral coverage ratio is also close to 100%. So this gives us some kind of comfort because our well-collateralized position of our Hong Kong CRE portfolio, it won't bring significant impact to our P&L. Yeah, and I also want to make one more point on the NPL. Actually, in terms of our downgrade, the second half, actually we have only downgrade 6 billion Hong Kong dollars compared to first half 13 billion. So our pace of NPL downgrade has been significantly slowed down in the second half.
And I think that brings back to the point of the state of the health state of the portfolio, our proactive risk management approach, and the ability, therefore, to then focus on growing our business. I think that is important because that's the overall financial performance and benefit that it would yield in terms of capital generation to continue with our dividend payout policy. Thank you.
I will add on. I think, Sam, you asked about exit NIM. Yeah. Okay. So I think as shown in the slides as well as in our financial pack, first half NIM is 2.29, second half NIM is 2.13, full year NIM is 2.2. In terms, while we don't do quarterly reporting and quarterly NIM disclosure, what I could say is that NIM is declining due to the market environment. In second half, the rates are declining. HIBOR, 1 month HIBOR is also declining from Q1 to Q4, started 4.6 in Q1, ended 4.3 in Q4. Now, if I look at from our management's perspective, Q4 NIM is actually not far from, it's lower than second half NIM, but it's not many basis points further from that.
Second question goes to Gurpreet, the right side. Yeah.
Thanks, Kenneth. Management, thank you for taking the question. 2, please, if I can kick off with buyback. So no announcement. I'm wondering how the board or management thinks about the overall capital position and then the willingness to return more capital. You did highlight that there was a buyback last year. So prioritize growth also and bring that into the picture. That's the first one. And second is just the general environment in Hong Kong. Seems like capital market activities are picking up. So are we seeing the outlook on fee income and how are we targeting these wealth management growth areas? Thank you.
Do you want to start with share buyback first, Say-Pin?
Yeah, Gurpreet. Let me take the question on share buyback first. I think share buyback is a form of shareholders' return of capital to shareholders. Maybe I give an overall view or overall picture of 2024 and also second half 2024. In 2024, the total actual shareholders' distribution is actually 15.8 billion. That is actually 86% of our 2024 attributed profit. That actually include Q4 2023 dividend payment made in Q1, Q2, Q3 dividend, plus the 3 billion share buybacks. That sums up to 15.8 billion, and that's 86% of our 2024 attributed profit. If you look at the capital walk, we present this capital walk for second half. Second half start the 30th June with a capital ratio of 16.8, as you could 16.6, as you could see there. And if you look at Q3 and Q4 dividend, the total is 8.3 billion. And 8.3 billion is actually 98% of second half 2024 attributed profit. So two key numbers to take away. For second half, we are distributing close to 100% of the attributed profit. And for full year, we are distributing 86% of 2024 attributed profit. On the outlook or forward-looking basis, Basel 3.1 come into place in 2025, and all banks are implementing that. In the past, we have advised market that has a positive impact to our capital ratios. Conservatively, we can say that it's around 150 basis points to 200 basis points from a capital ratios perspective. And just now, Diana mentions that we are very comfortable in our capital generating capabilities. This one, we drive it forward. With that, we think that we are confident in delivering a long-term shareholders return over time. Yeah.
Yeah, thank you. Thank you, Gurpreet, for the question. I hope Say Pin covered the share buyback and the waterfall was actually helpful. With regards to general sentiment, we do agree with you. We are seeing signs of stabilizing and actually picking up in terms of capital market activities. We also saw with government policies, both here in Hong Kong and in mainland, to stimulate the economy and the market. There are signs that, in fact, property market, for example, picked up as well. Last year compared to 2023, I think it was a 72% increase year on year. And I think overall sentiment from our clients in our engagement, we are also hearing more positive and energetic appetite to reassess, what they will be investing in. So I think that is a good sign. At the same time, I have covered earlier that our growth in NFI last year was predominantly fueled by wealth management business and the growth as such. This is not by any chance. This is a continuous effort to uplift our capabilities, our products and services, as well as our manpower to do so. And that's why we were able to see, amidst a year of challenges, our wealth management business income from such actually improved to 22%. In particular, I think I would like to draw your attention that the growth is actually very well balanced. In a sense, in investments, we saw 28% year-on-year increase. In insurance, we also saw 17% year-on-year increase. And if we look at new business premium for insurance, we have actually gone up to be the second largest insurance provider in Hong Kong. So I think those points to a direction of growth, which is what I would always like to bring yourselves back into. And the substantiation of ability to continue to grow. Now, we have also put in a lot of efforts to acquire targeted customers. And that's why overall affluent customer base went up 15%. But if you purely look at year on year, affluent customers went up 75%, mainland customers went up 81%. Now, again, that is an underlying, the underlying growth indicates that we have the ability. These customers were being deposited, bringing deposit will generate more wealth management growth. So I think that is in tandem, growing customers and growing our non-interest income with proven track record last year. That will remain a priority going forward. So I hope I answered your question, Gurpreet. Thank you.
The third question comes from Helen, ladies in the second row.
Thanks, management. Helen from UBS. My question is about the cost outlook. In 2024, we saw costs were up by 5.3%, while revenue only grew by 2.3%. What's your cost guidance for this year? Media reports indicate that HSBC has started a new round of layoffs to save costs. Has the parent set any cost target for Hensel? Thank you.
You do the first part, I'll take the second.
Yeah, okay. Okay, good point on cost. If you look at the dimensions of our operating expense in 2024, it's increased by 569 million Hong Kong dollars. More than three quarters, actually, 500 million, it actually is investment in IT. We invest in IT development and our IT operations. Why? For better customer service, for fraud preventions, and also improve our operational efficiencies or productivity, so-called. So we will continue to invest for our customers and also for a safer banking going into future. That investment will continue. But as you could see in our history and also for 2024 results, cost-income ratio is 36.6%. We are very, very, Diana is very, very cost-disciplined person and on his management, right? So we do not expect our cost-income ratio to materially change. And we will continue this journey to invest to future-proof our business, but at the same time, be very disciplined in managing our BAU or business as usual costs. Yeah.
Thank you, Say Pin. And Helen, I picked up earlier, you mentioned the cost increase was 5.3. I wanted to clarify our operating expenses went up 4%, but a lot of that, as Say Pin explained, is in the underlying capabilities. So capabilities, again, I bring back to fueling continuous growth going forward. Capabilities in terms of our resilience, in terms of our product solutions, in terms of our utilization, and actually the servicing to customers, the channels we use, and digitalization. So I think that is important. Now, alongside with all the transformation, if you would, you also asked the second part of the question, and that is the exercise or the undertaking at HSBC. I think that we have to say for HSBC. I don't actually have a comment on that, but I would say 2 points. One is we actually assess our resources deployment. That is not a new discipline. We have been assessing that. We have been upskilling our colleagues because of the evolving operating environment, that we will redeploy colleagues to different areas, and our colleagues would actually be taking up new roles. So that is not a new discipline, and that will continue. But has there been a cost target, your specific question, from the group to ourselves? Not to my knowledge. I haven't actually gotten a top target from them, a top-down target from them. But it is a business discipline to continue reviewing resources deployment and the needs of such. So, for example, we're growing wealth, again, we've said, and that requires then additional resources to put into our frontline to service our customers. We are alongside with the industry protecting our interests, our customers' interests. So fraud prevention is one area that we have put in a lot of investments, but you're not actually going to see that in a sense that is underlying capabilities. So I hope I answered that question for you. Thank you.
This question comes from Michael.
Hi, management. Thanks for taking my question. This is Michael from Citi. 2 questions, please. The first one is just a follow-up on the capital front. You mentioned that Basel 3.1 is going to bring 150 basis points to 200 basis points. Just wondering, is that permanent, or do you see any impact from the phasing of the capital, and how much would that benefit be permanent? And how would you think about the current capital ratio, and would you be willing to distribute that excess capital to shareholders? And also would be great to get your thoughts around dividends versus buybacks? Which method would you prefer? And the second question is on the asset quality, particularly on the Hong Kong commercial real estate. Just wanted to get a sense of the concentration risk of the unsecured book. Like, what would be the percentage of the largest borrower that represents our Hong Kong commercial real estate book? Yeah, thank you.
I take the questions. Yeah. Okay, I think the first one on Basel 3.1's capital benefit. Okay, the Basel 3.1's benefit come in three primary area. The largest chunk, which is about more than half, is coming from credit risk RWA decline. That is to do with the standard removal of 1.06 scalar factor for IRB exposure. Okay, that contributed more than half to the capital ratios improvement. About maybe around 30% come from operational risk RWA reductions, and the remaining is FRTB. So to me, of course, your portfolio will change and your profile and the things like that will change. But those are the benefits that is transpired through the Basel 3.1's implementations. And therefore, that should flow through going forward as well. I think the second question is on capital distributions. Now, I think we mentioned it before, we have the discipline to do 5-year capital plan every single year. And when we do five-year capital plan, what we look at the various scenario. I think we are not different from other financial institution, external environment, business growth opportunity, regulatory requirement changes, stress testings, and so on and so forth. And in the capital planning process, while we do all this, we are also considering on the capital distributions over the 5 years as well. So those are standard processes that we do, and obviously the management come up with all the tasks and proposals and go through a rigorous governance process, including our board and obviously sharing with our regulators. So I think it is early to say what will pan out, but this discipline on trying to commit to deliver long-term shareholders' return is always one of our top priority.
If I may elaborate before Kathy takes on a further elaboration on the unsecured book, the shape of such, right? On the question regarding return to shareholders, I wanted to really stamp on that to indicate 2 points. One is we are committed to deliver long-term return to shareholders. That is a commitment to our shareholders. All options are on the table. Share buyback, I understand that is a question there, but it's, there are different, you yourself mentioned there are different ways of achieving that and delivering the returns. Dividends payout is one, I think Say Pin mentioned that. So all options are on the table in our consideration going forward. And also, again, brings back to my earlier point on the confident. In order to be able to do that, we have to have the abilities and proven record and ability for us to sustain growth and to self-generate the capital required to deliver that commitment. And over to you, Kathy, with regards to the shape of our Hong Kong CRE book.
Okay, in terms of unsecured CRE book, actually over 90% or close to 95% are investment grade. I guess this is really key, and then they are listed company with diversified income. So at this point, there is no major concern.
Further questions?
Next question, please. Yeah, Emma.
Thank you. So I'm Emma from Bank of America. So I have a question about the volume growth. So for the loan growth, it remained quite weak for the full year and second half. And I know there is a large drag due to the sector headwind, but your growth is still a little slower than the sector. But on the other hand, your deposit growth are quite strong and stronger than growth. So given the imbalance or mismatch between the deposit and loan growth, what's your plan for volume growth this year? Do you think what are the areas you can grow your loan, and how do you plan to allocate the excess deposit to?
Thank you, Emma. I'll try to take that question and see if others have further elaboration on that. Indeed, assets actually has gone down in the past year, but I think there are two reasons to account for that. You mentioned de-risking, that is true, but at the same time, amidst a rather sustained level, higher level of interest rates environment, actually our clients are also paying down some of their loans. So there are two factors that have constituted to the decline in the asset balance. Now, more importantly, however, our strategy is to diversify our revenue stream. So in the midst of still a tough operating environment, a challenging operating environment, we're very selective with, we're still supporting our customers, of course, but in terms of deploying our resources, we're selective with the loans we grant, but at the same time, we are diversifying our resources into growing non-interest income. So I think that is key because we're looking at 1% there, but the overall view and the overall picture is important. The story of growth is not necessarily on just assets alone. The story of growth is on non-interest income. The story of growth is on overall income. That's why we're quite pleased. NFI actually more than offsets NII decline last year. But at the same time, we're also growing customers. Customers bring deposits. Deposits bring wealth. So I think that is the thinking and the strategy we have been pursuing.
Maybe I could supplement. I think if you look at the detailed financials that is disclosed, in 2024, one of the major reasons that our gross loans are declining, you could notice that loan for use outside Hong Kong is declining by 11%. That is our mainland China CRE loans. And just now you could see on the screen, our mainland China CRE portfolio has continuously de-risked, even in 2024, and now make 2% of our loan book. I think that's point number one. Point number two, if you look at, again, the detailed financial statements that show by sector, the major decline is the property development and property investment. But if you look at other sectors, IT increased 16%, wholesale and retail increased 11%, transport related increased 4%. And we also see healthy loans demand from aviations, auto dealers. So there is a more broad base, but obviously the overall number had noises in there with the declining and the de-risking and also some growth in other sectors. So I think Diana is also right in terms of what our focus on non-fund income growth, because the business opportunity is there on a cross-boundary growth. And so across non-fund income, there is actually healthy growth in various segments of the non-fund income growth, and we will continue to do that. And just now, Diana mentioned of 81% on mainland China account opening, 75% of affluent customer accounts increases. All this will give us a good foundation to build our non-fund income going into 2025 and forward.
And the final point on your question, when we diversify into continuing to support and to grow our customers, our corporate customers, there are areas that we have made good progress in. So these are sectors for the likes of energy, automobiles, vehicles, right? Advanced manufacturing, tech, and e-commerce. So these are just to name a few of areas we are venturing into as well.
One area of growth in 2024, also in our sustainable financing, that went up by 26% in 2024 versus 2023.
Thank you, Emma.
In interest of time, we'll take the last question. Is there any last question? If not, here's the end of today's analyst session. Thank you, everyone, for joining us.
Thank you. Thank you.